It is never too early or too late to save money for retirement, and individual retirement accounts, or IRAs, are a popular way to do it. In today's Financial Friday, financial advisor and planner Esther Halt from Star Financial Solutions is here to explain the difference between traditional and Roth IRAs. Great to see you, Esther.
Good to be here. Happy Friday.
Happy Friday. Boy, these are words we throw around all the time, and I think a lot of us don't completely understand what this means. So what is the main difference between Roth and traditional?
Well, first of all, this is for Pamela Perino, a viewer who emailed me a few weeks ago and wanted us to bring this topic up during the show.
I love that.
Basic differences between Roth and traditional. So they both grow tax deferred. But when you put money into a Roth, it is after tax dollars.
Okay, so after your paycheck comes home.
Right. When money you've already paid taxes on. When you put money into an IRA, it's pre-tax dollars.
The traditional.
Right, and the traditional IRA, and then you can take the deduction on your taxes.
Okay.
So it's pre-tax.
Okay, and I know figuring out that whole deduction thing requires probably you talking to your CPA.
Right.
We decided that we weren't going to get crazy in those numbers because it gets scary very quickly.
Correct.
But so, okay, I understand that the pre-tax and the after-tax, but how are they the same? Because don't they all provide some level of benefit for us?
Right. Well, they as I said, they both grow tax deferred.
Okay.
And they're both for retirement. The other thing is the beneficiaries of both have to take qualified minimum distributions.
Okay.
On a traditional IRA, it's taxable, except if you take QCDs, like we discussed last time. And on a Roth, it's not taxable.
But they
for
also
the beneficiaries.
come with rules, right? Important rules, both of them, that we need to go over.
Correct. So the biggest rule is this money is, for contributing, you can, the limits are $5,500 a year, or if you're over age 50, you can do $6,500 because there's a $1,000 catch-up.
Catch up meaning you didn't put enough in before, so.
I guess because we're old.
I think that's very funny.
So you can do an extra $1,000. But the biggest thing is that this money is for retirement, and I can't stress that enough. If you take the money out too soon, you will get penalized, you will pay taxes, it's ugly, don't do that. So if you take money out of a traditional IRA before you are age 70 and a half, you will pay full income tax on everything that comes out, plus 10% penalty to the government.
Wow.
On a Roth, from the moment you make your first contribution into a Roth, you have to have money in that Roth for 5 years. And you have to be 59 and a half. So
if you're starting late, you have to pay attention to that 5 years.
Right. You need to go 5 years and 59 and a half. On a Roth, if you take the money out before those are met, then you pay taxes on the gains, and there's a way they figure out what's gains and what's what you put in. Again, and plus 10% penalty on those gains.
So here's my question. We hear people say from time to time, maybe they've had a job loss or have just gotten into financial trouble or paying for college, I'm hearing. So I just borrowed against my 401k. Does that essentially mean they're breaking the rule and pulling this money out with penalty?
401k is different. That's a retirement plan.
Okay.
And sometimes you can make loans from a 401k, sometimes you can't. And it depends on the documentation that goes along with it.
But IRAs are set.
IRAs are different, and you cannot borrow from an IRA.
So after you retire or reach a certain age, can you take it all out without a penalty?
Without a penalty, but you will pay tax.
Yeah.
However,
I've learned that.
Well, except on a Roth.
Yes.
I have a lot of clients that are reaching that age now and are beginning to take their distributions. And thank you, clients, because they give us the distribution, and if you give it to a qualified 501c3, you will get no tax.
Yes, Marcia, we learned that with Esther just last visit.
We talked about that.
Yes,
Yeah,
which is really
absolutely.
important. One last question about taking it, though, and I think Linda makes a good point. Is it better to take it all at once, or is it better to spread it out for the tax reason?
Well, understand that while the money is in there, it grows tax deferred.
Right.
And that's always a good thing. On a Roth, when it comes out, you don't pay tax on it. So if you have to take your required minimum distribution, take that. If you need more, then you might want to go to the Roth so that
Right.
you don't pay extra
But
tax.
if you don't need more, better to leave it in there and let it grow.
And as usual, talk to your tax consultant before doing any of this.
Yes, right. This one gets a lot of tax implications.
Yes.
So, all right, well, we appreciate
Absolutely.
Esther and all the heads up on how to best save for retirement. You can contact her and find more financial information at starfinancialsolutions.com. Coming up next, the Car Circus performs.